Welcome to StockMarketPending.com. Basically, what we're doing here is that this is a 2010 1040 put on the S&P. The value, by the way, welcome to StockMarketPending.com. The value of that was over here. Let's take a look. The highs were $99.50 a contract. The current low today is 55.60 on 7/21 was that low right here. And we are now looking at, as we move through the earnings season and whatnot, of where that value was and where we're getting down in this wholesale value. Because, once again, what Mario says is if they don't take care of, this is the earnings season, number one. So as we go through the earnings season and we try to get what I call a very lame, weak summer rally in the U.S., is that as that gets ready to fizzle out and we get most of the S&P 500 earnings out next week and the week after, but more so next week, is that we're going to be looking at setting alarms on this one here. There's another alarm at 42.50 that needs to be set. $42.50 on the lower end of the December put contract. Another one that we are looking at is the strike price for the 1050. And basically, folks, it's an August 1050 on the put. Now, let's be aware that on the same hand of that is that on a 60-minute chart right now, I'm going to show where the S&P 500 is relative to where this price is here. This is a deflated put. They were extremely expensive over here at the high of 67.50. And as I was telling everyone, when we had that last big sell-off, these broke off of that same price level. The low here was 17.60. This low here, folks, happens to be 12.50. That's $5 lower than that last breakout. So when the stock market sold off during the period of 6/21 to the top of 7/1, at 7/1, that was at the stock markets went way down or way up, and this broke out when we had those daily rallies there for about 7 days. We had that reversal here. Nonetheless, because of our expertise, and our expertise allows us that if the S&P itself cannot break above the highs, here's that 3-minute chart of RIM. Let's get your 60-minute chart back up, and let me show you again, is that this 60-minute chart down here, I'm going to show you where the highs were on the S&P. So basically, the last time that we rallied on up, you can see clearly on 7/6, right after 4th of July, we had that nice rally, and we continued to grind it out higher. And what we're going to put in here is that this line is a top. Here's the current top. Here's the failure top. Here's the consolidation at resistance that gave weak. And here is where the original downtrend started in the S&P. And we put in the lows way down here. Now we're on the upper high of that, which is also bringing the cost of this all the way from, like I said, whatever this cost was, it was $67.50 a contract, clear down here to $12.50 per contract. Now, we are looking at buying that. We have taken all of that dollar risk of buying any contracts. Yesterday's close was $22.50. So, having said that, we are getting down where when we're going to wait and see how many more earnings reports come out after the close tonight with Amazon and a lot of other ones. And more importantly is each morning before the market opens up in pre-market, you get a lot of before the opening bell earnings that will be in the S&P, which will either support that price level and or if there's any gap up in pre-markets, this comes down. And I'm going to set alarm here. There's another one that I want to set here is at $10.80. 10.80 on the 1050 put. Let's take a look at the current failure top that could happen is that we would go to the 1090 call. The 1090 call had came off the bottoms during that last rally at $10, so that was a nice move as far as the 1090 call that could have been bought. And we're coming up here, so we want to monitor the value that there was a $10.60 move, which would mean that if we buy that put side, we definitely want to not give up the opportunity of using this side of the market to minimize any downside risk with these profits that would offset our cost on the original entry of the short side of the market, which would be that put side. Now, I'm going to look at the 1070 call, and basically the 1070 call back over here, man, it was $70. You had a rally in the contract when the S&P went up. We're going to be monitoring that they're up $12.10. We never ever want to not miss. We always want this side of the market, because when we're buying the call side, when markets go up on a single day, we're using that one day as that entry, and the bid is 38.20 by 42. So if you own these, the closing price the other day, you could come out here and say, okay, you could sell for 38.20, or you could put them out and see if someone would buy it at $40.90 or something like that, and see if he would want to come and buy you. You would be in control of offering it out, because you're king wholesale, so that makes you the market maker here on the way out. That's the call, but we're also going to take a look at where that 1060 put is relative to the S&P structure. And once again, what I am going to say, that's a 1060 put, which is a few handles above the market. And we're taking a look at that. And we're taking a look at where that they're down $10 at the put price today. I'm going to set alarms here at 1280 and 1350 for today. And we're going to see just how inflated that they get. Then when we get in, we're going to